Welcome back to my channel. Balance sheets matter. Today we're going to look at PayPal stock and I'm going to do a financial analysis on PayPal. So I'm going to dive into financials, look at the good and the bad, tell you what the different financials are telling us about the company. We're also going to look at some of the technicals, figure out if PayPal's a good buy and what a good target for it is in the future. Now, I do think PayPal might be right now be one of the best buys in the market, although in the short term, I do think it could go lower. But just quickly, a little bit about myself. I do run my own business. I've been in e-commerce for over 10 years, and I have been using PayPal as a merchant for over 10 years as well. So I might have some significant, unique insights into the company. But before we dive into analysis, make sure to subscribe to my channel. Balance sheets matter. I do stock analysis videos. I try to get out at least one per day right now. So if you want to find undervalued stocks, get different stock ideas, you're going to want to watch my videos. And if you do have a video you want me to do, stock you want me to analyze, leave it in the comments below and I'll try to get to it because I'm a small channel, so I can take subscriber requests right now. So let's get into the analysis. But the first thing to understand about PayPal is more than just PayPal, the little PayPal button you see when you buy. They actually have a bunch of different brands all around payment processing: Braintree, ChargeHound, Happy Returns, Honey, Hyperwallet, Paidly, Simility, Venmo, Zoom, Zettle. These are all different aspects for mass payments, for phone reloading. Venmo's more family to family. You have mass payments from the Hyperwallet, finding deals with Honey, ChargeHound for dealing with chargebacks, and Braintree, which is kind of their white label, private label payment processing. Actually, Booking.com, when you're processing your Visa or MasterCard over Booking.com there, it's being done by Braintree with PayPal there. So PayPal is collecting a little bit of every transaction that goes through there. And one thing people seem to not quite understand so much about the payment processing industry, well, some of these backend services such as ChargeHound or Happy Returns or even Braintree are really decided by the merchant wanting to use them. A lot of services such as, say, Venmo and even the PayPal button, those are more consumer oriented because basically the consumer decides what they want to use and the different merchants are going to basically accept everything, whatever the consumer wants, such as Amex, for example. You might hear a lot of times Amex has very high processing fees, so why would anybody accept Amex? Well, there's consumers that have Amex cards and they want to use them, so if you don't offer Amex, you're not going to get the sales. And this is the same with PayPal. People want to use PayPal. They like that extra layer of protection. They also like things like the PayPal's new Pay in 4, the different PayPal financing. So if you aren't accepting PayPal, you're missing out on sales. So for them to get squeezed out by competition seems very unlikely, since I think PayPal has a very big moat with the consumer. So now let's dive into the financials. First of all, I like to look over a few of the high-level metrics. I sometimes like to glance at this Guru Focus value band here. Sometimes it's accurate, sometimes it's not. In this case, I think it might actually be fairly accurate, since we were extremely overvalued over here, and I do now think we are extremely undervalued. And it does seem reasonable in the next few years. Getting to $160 seems very much in the cards. And right now, PayPal is sitting at about a 17 PE ratio with an extremely low forward PE of only 10.71. And PayPal doesn't pay a dividend. They mostly just focus on buying back shares and growing their company, since they are still in the growth stages. Now let's dive into the financials. First, let's look at the overall growth trend here. As you can see, in this current year, they're expected to do about $29.5 billion in gross revenue. This is based off the average analyst estimates. The year after, 32.3, and the year after that, 36.3. This company is definitely not stalled in growth yet. This is a good 10% growth per year. Well, the last 10 years, they were doing closer to 18, so the growth is decelerating. 10% is still a very respectable number. A lot of companies that even have multiples in the mid and low 20s have growth rates in the 10% per year, which PayPal is sitting at right now. So let's dive into some of the metrics. Return on invested capital and weighted average cost of capital. It's good to get an idea of these metrics right now, although they aren't the end all be all. Return on invested capital, PayPal has a pretty good one, return on invested capital. Usually at the lowest, they're around maybe like 10%. One time they're a little bit under, but they're getting up to 20 in the mid-teens. So when they reinvest their money into the company, they're getting a good return based on the assets on their balance sheet. And their weighted average cost of capital is lower than that. It used to be more around 8-7%, but since their share price has gone down so much, their weighted average cost of capital has gone up, since if they wanted to issue more shares to raise capital, it would be more dilution for them, because the stock, in my opinion, is quite undervalued right now. But PayPal, as we'll see in their balance sheet later, they aren't going to be needing to issue shares since they have a very healthy balance sheet. Now let's take a look at the income statement. As we already went over, growth is really good going forward. They're almost at $29 billion. I like first looking at the gross margin. You can see the gross margin has crept down to about this 48.4 from before it was in the 60s. Well, typically when the gross margin is declining, this can mean a company is losing its competitive edge. I don't think this is so much in PayPal's case. I think it's because they're diversifying in all these different sub-brands in different parts of the payment processing, such as Venmo or ChargeHound, etc., where some of these different businesses, they have lower gross margins than just the main payment processing. But we can also see basically selling and general admin, they've actually brought it down over the last few years. So this is good because, well, the revenue basically from 2020 went up $7 billion. They've managed to keep their selling and general admin flat. So this is a good efficiency for PayPal, and we may even see get them more efficient in this in the future as AI creeps in. A lot of this customer service stuff can be automated and done through virtual AI bots and having to actually hire people. You can see research and development. They're still actually spending quite a bit on research and development. This is to basically develop these new platforms, develop new technologies. It's new software. PayPal is a software company, and they basically spent $3 billion in the last year, and that's on $28 billion in revenue. So as they grow and as they mature, this number may actually not increase at the same rate as the revenue, which means their operating margin is going to be increasing over time potentially, and this may mean more revenue for the shareholder on the bottom line. And we can see their operating margin. It's typically been above 15, usually around 16-17%, and we're keeping to that, although last year it was down to 14.7, which might have been the cause of some of the pressure on PayPal stock. Next, we want to see what their interest expense is. Their interest expense in the last year was $350 million from their balance sheet. I already know they have about $10 billion in debt. So just think about that. Their effective interest rate they're paying is only 3.5% on their debt. And that's actually a pretty good interest coverage ratio for their operating income of 4.7 billion. I usually like ones with about a 1 to 10, but also what you have to keep in mind right now is because interest rates are high, they're making a lot of money on the excess cash in their balance sheet, although we can't always count on this in the future, of 356 million. So their net interest right now is nothing. It's like the company's almost debt-free in a way, even though it really isn't. But even if they weren't to have this interest income, or because interest rates go down, or they're going to invest all that money, 350 million interest expense on 4.7 billion operating income is a very healthy state for a company to be in. I really like the look of that. And we can see basically their net income here been increasing. It's been plateauing a little bit over the last few years because the fluctuation in the operating margin. There was also some one-time incomes here and then some one-time expenses, but it should be increasing going forward, and that's been leaving them a net margin typically around this 12, 13, 14%. But as I was saying, as the company scales and it gets more efficient, this operating margin or this net margin may actually increase in the future. And we look at their shares outstanding. You can see the shares have gone up a little bit. They are a software company in a way, so they do have to do a lot of share issuance basically to pay their different developers, and this is increasing their share count, but they have been buying shares back more recently. So this is a good trend that they're starting to buy more shares back, since it means they're making a lot of excess income apart from what they can just reinvest in their company. So let's take a look at the balance sheet. Balance sheets are very important. Balance sheets matter. That's the name of the channel. So current assets currently sitting at $54 billion. We're going to look at the current ratio. Total current liabilities, just under $4.2 billion. They have a very good current ratio. More current assets, the more current liabilities. And we can see all this excess current assets they have is all in cash, which is great. They basically almost have $10 billion in cash and cash equivalents. This is where they're making that excess interest from. So they can also use this money for share buybacks, and with a market cap of only 66 billion, I think they can almost buy back potentially 15% of their stock at this price. And I think they do have some authorized buybacks, so this is a really good position for PayPal to be in, even though stocks being beaten down. This looking like a great time to buy because they can return a lot of value to shareholders by buying back shares. We look at their total assets, 74 billion, and they have about 11 billion in goodwill. We always have to kind of take goodwill out when looking at it because it's not really a real asset we can do with anything. And typically, this because it's from acquisitions, and typically it'll be written down over time if those assets they bought aren't performing as they should be, which typically happens over time. But still, even considering that, their total liabilities are only 54 billion. As I said, they have about $10 billion in total long-term debt. This isn't very much debt for them because it's only costing them 350 million per year. So this is a pretty healthy balance sheet, leaving them about 20 billion in total stockholder equity. Although remember, 11 billion dollars of this is goodwill. So in reality, they only have about 9 billion dollars in real tangible equity. But that's really good because that's almost all cash, and their market cap is only 66 billion. So they have a very healthy balance sheet. I like this balance sheet. So let's look at the cash flow statement and see what they're doing with their money. You can see here the cash flow from operations. As I was saying before, they're getting a lot of cash flow because of the stock-based compensation. But what they are doing is they are repurchasing the stock. In these early days, they basically weren't, but now they're able to repurchase more stock in the last 5, 6, 7 years, and the amount of stock they're repurchasing is exceeding the stock-based compensation by quite a bit. The last year, their stock-based compensation was about 1.2 billion, but they repurchased 4.9 billion dollars of stock, and it looks like they're doing a lot of buybacks right now when their stock is cheap. So I really like to see this. And then we can see how they're basically reinvesting their money into businesses. They do spotty acquisitions when they see the opportunity. And I think this will probably happen a lot more in the future. Since they're in the payment processing industry, they're probably going to buy out other payment processors or other adjacent businesses for chargebacks and returns like they have, and grow their portfolio out there. Since if you have a suite of different products, you get one person in for the one thing and then you can sell them all to others. It's a really good business model. It creates a lot of synergies. And then we have the purchase of plant, property, and equipment. They are having to do a little bit of that. That's more physical type infrastructure stuff. Most of their investment is into research and development and software. Another interesting thing just to look at here is the depreciation is a lot higher than their purchase of plant, property, and equipment. So basically, they're not repurchasing much as physical, buildings and land and this and that than they're spending. This may mean they would have to increase this in the future, or this just may mean that once they've depreciated this stuff from the past and these two numbers start to normalize, this may mean they're going to have less expenses in the future, and we're going to see that growing net margin again. So depending how you look on this, this could be a bullish factor or it could be a potentially bearish factor. We're going to have to see where it goes in the future. And as we go down basically the balance sheet, we can see they've had positive cash flow in all years. So this is looking very good. So overall, PayPal's financials are looking really good. I think they have a good growth going forward. It's a healthy balance sheet. This company's in a really good place. So let's basically take a look at the stock chart, look at some of the technicals. And I think really what the real problem was is PayPal just got into a bubble with a lot of other things in basically 2021. And now that bubble popped, because $300 value really doesn't make much sense for PayPal in 2021, but neither do I think $60 makes sense too. But because when you get so high up there and that momentum starts going down, momentum can just take over and keep driving your stock lower and lower and lower, and people start up making stories around why the stock's going down. Typically, a lot of times the stock price is going to create the story, and if it's going down, then people get worried. They say, why did I buy up here? And they're selling down here, driving the stock down lower. Now myself, I already have a little position in PayPal. I started buying in the low 70s here, and then I'm planning on buying again in the 60s and the 50s here. And then if it goes even lower, I think this could potentially go as low as 40, just purely based on momentum alone. You can also see the price volume profile. Again, for a fair value, PayPal is actually probably realistically somewhere valued in about the 150 range a few years going forward. As I was showing before in the little chart here, I think this is fairly accurate. And we can do a little bit of quick math. I just want to bring up some of the analyst estimates here. Okay, now that we have our interactive chart here, let's bring up our EPS with estimate, the average by the analysts, and we can see in the next couple of years, they're expected to do about $5 of EPS in the future. But we also have to remember about the strong balance sheet where they have at least at $9 billion in excess cash. So when we apply that in, if they did it for share buybacks or we just take that out of the value, this is equivalent to about $5.80 per share. It's about 80 cents of value EPS per share, depending how we apply it. We give that a reasonable 25 multiple, which is pretty reasonable for a stock that's growing 10% per year with a good moat. And we also have the bullish catalyst in the future of net margins potentially growing in the future. And we arrive at about $145 per share, right in what I was talking about before. So I hope you like this analysis. I hope it gave you some insights into PayPal. Remember to subscribe to my channel, like the video, leave a comment if on a stock you want me to do analysis on, and I'll see you in the next stock analysis video.